short while ago, Minneapolis Fed President Neil Kashkari joined us, had this to say about a potential pause in rate hikes on the way.
I think right now it's a close call either way versus raising another time in June or skipping. Some of my colleagues have talked about skipping. Important to me is not signaling that we're done. If we were to skip in June, that does not mean we're done with our tightening cycle. It means to me we're getting more information. Do we then start raising again in July potentially? And so that's the most important thing to me, is that we're not taking it off the table.
Our next guest has been a critic of the Fed's rate hiking path. Joining us now is Jeremy Siegel, Professor Emeritus of Finance at University of Pennsylvania's Wharton School of Business. And Professor Siegel, what Kashkari had to say there essentially is data dependence. We're at a point where the target rate is not too far from where they anticipated it needed to go. On the other hand, inflation not down to their goal. Does that make sense to you here?
Yeah, I think it is very data dependent. Let me tell you the data that I think it's dependent on. I think it's dependent on that payroll data that we're going to get a week from Friday. If that is really hot, and if the unemployment rate ticks down to a new 70-year low of 3.3%, boy, the Hawks will be very active at the June meeting. However, if there's a slowdown as expected, if payroll growth is under 100,000, if the unemployment rate goes up to 3.5 or even 3.6, I think that absolutely means a pause. So I'm looking at that payroll number as probably the deciding number. I do know that they get that CPI on the first day of their two-day meeting for the month of May, and certainly that will factor in. But I think employment is the key to Fed decisions now.
It's fascinating in the sense, Professor Siegel, that we have had no response in terms of slowdown in employment, really, in the observable metrics after 500 basis points of Fed hikes over, a little more than a year. So I do wonder if that still seems to be the swing factor that it has always been historically.
Well, I say no slowdown is a little bit of an overstatement. If you take a look at the increase in non-farm payroll, you do see a downward trend. Mm-hmm. It isn't as downward as we thought. Actually, not as downward as I thought. I thought we would, be getting near zero and maybe a negative print. That may have to wait until fall. But definitely there has been a slowing, and in fact, even Jay Powell has acknowledged that there has been a slowing of that rate. It's just been a bit slower than we thought, and I think that's what's encouraged the market. Hey, I don't see a recession there. Earnings are holding up at this point, and by the way, I don't think there's going to be. Not only do I not think, I'm virtually certain there's no default. And no one wants to be caught short on the market on a day the deal is made. So I think we have a lot of shorts are covering for that potential outcome in the next couple of weeks.
Jeremy, you've been right about inflation coming down, and it has come down nicely with what you've talked about for a long time, which is the decline in some of the monetary aggregates. But what we're hearing from the Fed is two things. One is the progress has slowed, and you can kind of see that if you look at the inflation numbers. And the other thing is that it hasn't come down enough, at least even with a negative year-over-year change in the money supply, you haven't gotten back to the 2% target. Is your advice to the Fed just let it run and it's going to come back, or do you think maybe they might have to do more here in order to bring down inflation to their target?
No, they shouldn't do more. If you take a look at sensitive commodity prices, they're still in a downtrend. I keep current CPI and core using the Willow, the apartment list rental, the Case-Shiller, and by the way, I get core now at year over year too. And in fact, even Kashkari and Powell acknowledged that in the second half of this year, as the lagged BLS housing data shows the decline, they're going to get near their target. I think by continuing to raise, they're adding way undue risk. Sentiment isn't good. There is that downturn, and boy, I'll tell you, if you get a negative print on payroll, it's going to hit the headlines, and that could turn psychology, and you don't want that to happen. My feeling is they pause, and hopefully, I think they're actually going to be reducing by year end.
Jeremy, I have to ask you about the earnings outlook. Are earnings now priced for a recession at this point, or do you think there would be further to go if indeed there were a recession in terms of marking down earnings?
Well, interestingly enough, earnings are holding because, what we've been getting so far on the first quarter has been good. Guidance has been mixed. Listen, if we have a severe recession, it'll be hard for the stock market to make progress. Then I said right. You're at a 10, 0 to 10 for the year. We're at that 10, as Mike said, with dividends, we're 9 right now. So we're at that upper. A recession would keep it bouncing around there. But I still think 2024, even with a recession, looks like a very good year for the stock market.